All right, we're making good progress. We're now on to the fourth of our overall hedge fund strategies. It's the fourth one. It's opportunistic, which is pretty broadly defined. Okay, so wide-ranging techniques here. We talked earlier on that some strategies take a bottom-up approach. This is the opposite. Okay, so an opportunistic strategy, very much top-down. Okay, we're going to be taking a view on how regions are going to perform, perhaps some industries, and overall asset class. We're not going to be looking so much at individual securities to make our decisions. Overall then, the risk is a very macro approach, so you'd expect a macro source of risk, which is very much the case. Market cycles, of course, is just one element of that. A bit like we saw with some of our previous strategies, there's a couple of different flavors here. We could take a technical approach, trying to identify where overperformance and underperformance is going to be, or we could use company and industry fundamentals. Individual managers then might use quantitative or systematic implementation approaches here, trying to use algorithms, some sort of mathematical analysis, or a bit more of a gut feel. So either flavour could apply. We're going to be looking at two subcategories of opportunistic strategies. The first is global macro, and the second is managed futures, which is a bit more niche and specialised. So let's start off with global macro first of all. Global macro sounds high level, doesn't it? And it certainly is. So we're trying to identify the direction of travel of global economic variables. It could be inflation, exchange rates, yield curves, the policies of a central bank, etc., etc. The two different approaches here, there's a thematic approach where we're going to be taking one of those risk factors and going to be trying to trade off of it. So if we think that interest rates are going to rise overall, then we want to identify companies that are going to benefit from rising interest rates. We're going to take a long position on those. We're going to identify companies that are not going to benefit. They're going to be disadvantaged and short those. So once again, we've got long-short combinations happening in this strategy. Directional, we're simply going to be buying companies that are going to benefit from, in this case, this example, free trade deals. So again, it's a global macro factor. A free trade deal between two countries rather. We're going to simply take a long position in companies that are going to benefit. So mainly long in terms of directional. Okay, where you've got a low volatility, mean reverting market, then the strategy doesn't tend to do too well. When the markets are reasonably volatile, when the market's going to move quite a great deal in response to one of these factors moving, then clearly you're going to get a better return than if the market's going to take a long time and then very quickly mean revert. So we want high volatility, non-mean reverting markets here. Also, a bit like our event-driven strategies from earlier, if the factor, be it interest rates, the free trade deals, inflation, if it doesn't move the way you think it's going to do, then you're going to lose some money. So if those events don't materialise or other risks affect your positions that you didn't previously identify, then you might be in some trouble. Okay, implementation, a bit of repetition of what's gone before. So top-down analysis, looking at macro trends, it tends to be more discretionary, the more gut feel approach rather than systematic, but systematic approaches do exist in this strategy. The manager focus, as we talked about before, technical versus fundamental, discretionary versus systematic, but a bias towards discretionary, we would say here. Because the returns might need some amplification, we put a lot of leverage in there, sometimes 600 to 700% of the fund's assets. Strong diversification potential for global macro, so some nice excess returns on offer. Managers who are contrarian, who can identify directions while the herd hasn't caught up yet, they tend to do very well, as you might imagine. They invest ahead of the other managers, they get ahead of the curve and make those profitable investments. Studies have shown, and you can't argue with studies, that there's often a right tail skew. Okay, so perhaps more of a tendency to positive than negative returns, which clearly is beneficial. Okay, so that's our global macro, high level approach. Now let's look at managed futures, much more specific. This is a long short strategy specifically dealing in derivatives. Okay, so we're going to be taking long short positions in derivatives like swaps, forwards, futures, options, etc. The nature of derivative investments would entail a lot of leverage, and that is certainly the case here. So lots of leverage involved in this strategy. One of the great things about derivatives is that there's a lot of liquidity there, often far more liquid than the underlying asset which the derivative is based on. So you've got a lot of liquidity. but might be subject to crowding. So you've got a lot of investors who are perhaps making the same trade, they're making the same bet, in which case any perceived mispricing might quickly be eliminated. Okay, in the portfolio, low correlation with traditional assets. So as soon as we see that, we're thinking diversification benefits. Low correlation is a good thing from a portfolio management point of view. In times of market stress, again, you've got a right tail skew here. So market stress, lots of volatility, lots of assets going down the pan. Well, managed futures can provide a bit of light relief for that sort of situation. Tends to be systematic approach rather than discretionary, so a bit more analytical for managed futures. A couple of different approaches here, which is looking at a time series momentum strategy. Well, we know what a momentum strategy is. We're going to be buying securities whose prices are rising because we expect that price rise to continue for the foreseeable future. We sell securities with a falling price. A cross-sectional momentum strategy is exactly the same thing, but within an asset class. So we're going to be dealing solely within equity or solely within fixed income. The actual trading strategies themselves, too numerous to mention here. There's a wide range. Many of them are based on volatility trades and momentum. And well, with any of these types of strategies, the key is when to get out of your position. So when to exit the trade. When do we know that the momentum's coming to an end? When do we know that price rise is about to fall off a cliff and go down? So you're going to be using the time-tested signals to exit those trades at the right point. Okay, 5 out of 6. The end is in sight. Okay, the fifth of our 6 type of strategies is specialist strategies. So a bit of a different to the opportunistic one. We're going to be looking at a couple of very specific types of strategies here. We're going to look at 2 subtypes. I'll just reveal them right now. We'll look at volatility trading and then reinsurance or life insurance settlements. Very specialist, therefore manager knowledge is key. Okay, lots of experience and lots of skill required here. If you get it right, there's going to be high returns on offer, and again, low correlations with traditional assets. So you've got a double whammy there of benefits, high returns and diversification benefits. Let's dive in straight away then to the first type of specialist strategy, which is volatility trading. The idea here is that we're going to be, well, a bit like we saw with our convertible bond arbitrage before. Okay, so one of the main determinants of option price is volatility of the underlying asset. We want to buy options, we want to buy securities where the volatility that feeds into the price is underpriced. Okay, so we buy the underpriced security, or the security with underpriced volatility within it, expecting at some point the market to wake up, realize its mistake and bump up the price when they realize that the volatility is higher than they thought. So we purchase the underpriced volatility and we sell the overpriced volatility if we can. Now, one of the little quirks of this type of derivative investment is that when you've got a net long position in volatility, you have positive convexity. Now, positive convexity is good news for an investor. We'll do this in more detail when we come to fixed income, but positive convexity amplifies price gains and it sort of dampens price losses. So positive convexity tends to be a good thing from an investor's point of view. Okay. Also, we could be looking to sell volatility to equity investors who are seeking to buy. So if we think that the volatility inherent in security is actually overpriced, then might be able to sell it to an equity investor who hasn't quite cottoned onto that yet. Okay, so I mentioned a second ago that the convexity of derivatives and volatility derivatives can result in very large gains and not quite so bad losses. Convexity is a good thing. Benchmarking them, though, is tricky. Okay, we simply don't have the easy to use, the go-to benchmarks that we do for other asset classes. There are exchange traded volatility indexes, or there's a volatility, the VIX is a volatility index. Options that are traded on those exchanges, usually liquid, as you might imagine, over-the-counter securities, much less liquid. And liquidity is always a good thing from an investor's point of view. Okay, how to implement a volatility trade? Well, we're going to be going long. We saw it before. We're going to be going long on volatility that's underpriced, going short on volatility that is overpriced. So we're going to be buying more than one option. Various strategies that we will look at in more detail when we do the derivatives readings, if you haven't come to that yet. So a straddle, calendar spread, bull and bear spreads, they all involve buying an option and selling an option, sometimes more than one. Okay, so you're going to be talking long-short positions there. Your traditional derivative strategies have a part to play. Over-the-counter options, well, you're just going to have to do a deal literally over-the-counter with the counterparty. The tricky bit, though, is that you've got counterparty risk. Not only the risk of not being able to find a suitable counterparty who wants to take the opposite side of the trade, but even if you do and you sign on the dotted line, there's some credit risk and the risk that they don't follow through on their obligations. Specifically with futures that are traded on the VIX index, we like the liquidity, we like the fact there's no counterparty risk, but the returns are perhaps offset by the fact that the index tends to be mean reverting over time, and other traders may have got there before you. Very specific type of trade here is a volatility swap, sometimes known as a variance swap. That's a forward contract, and the payoff there in the forward contract is going to be the difference between the observed or realized variance and the predicted variance at the start of the trade. Okay, so very specific. In the portfolio, lots of diversification. We saw it before. There's negative correlation with the market, negative correlation with traditional asset classes, and also some high returns as well, which was in the previous slide and isn't repeated here. Okay, so there's our volatility strategy. Second type of specialist strategy we're going to look at is very specialist indeed. It's a reinsurance or life settlement strategy. Okay, well, hopefully we're familiar with the concept of life insurance. Okay, we pay a set of premiums, and in the event of our death, we get a big payout. So let's say you have some life insurance and you want to cash it in early. You decide you want to get the benefits of the financial injection without the downside of actually having to die. So you sell, the insured person sells their insurance policy to a hedge fund. So the insured person receives a big chunk of money and the hedge fund basically takes over the life insurance policy on the insured person's behalf. So the hedge fund is then going to pay the premiums for the policy. What's in it for the hedge fund? Well, when the person dies, they're going to get the big payout from the policy. So they receive the death benefits. From the insured person's point of view, they might receive more than they would from the insurer in the event of their death, particularly in present value terms. If you think about the present value of their receipt, they don't have to wait 40 years till their death to receive the money, or their estate that receives the money. So they receive more. There's a present value benefit to the insured person from selling the life insurance. Doesn't just have to apply to life insurance, this stuff. We've got catastrophe insurance here. So we're going to be buying, the hedge fund is still going to buy an insurance policy from its customer, who in this case would usually be a reinsurer. What sort of catastrophes are we looking at? The usual disasters, so earthquakes, tornadoes, etc. Hurricanes and floods are mentioned as well. So again, the benefit there is that the hedge fund benefits when the catastrophe occurs. They have to weigh up the likelihood of that catastrophe occurring. They're very typically illiquid types of investments, though. They're very niche and very specific. Okay, in order to correctly predict the death of the people, or to correctly predict the catastrophe occurring, lots of expertise in these types of contracts. They will become the beneficiary. So if in the exam, if you have to consider, well, who's going to benefit and who's going to gain? The hedge fund is buying the insurance policy. So when the bad thing happens, they're going to benefit from that. You're always going to be looking at the most attractive return. So you want to pay out as little as possible. If you think about life insurance strategy here, we're going to be paying out as little as possible in a lump sum to the insured person. We'd like to have low ongoing premiums. And sounds a bit bad, doesn't it? Sounds a bit nasty, but we hope the insurance person is going to die soon. Just from a financial point of view, that's when the benefits will accrue. So from a human point of view, we hope obviously everyone has a long and happy life. In the portfolio, yep, we get excess returns, nice high returns if you get it right, if you've got the skills, but low correlation with traditional asset classes. So again, you're looking at diversification benefits from a portfolio management point of view. Okay. We finally got here. We're on the 6th of our 6 hedge fund categories. And this is actually not really a category on its own. It's a bit of a combination of lots of the other ones. So this is multi-manager hedge fund strategy. So in some level, it might be in-house or it might be external. Our investments are going to be managed by different hedge fund managers with different strategies. So we're using a portfolio, a nice mixture of all of the previous strategies. Periodically, you're going to need to rebalance and adjust the holdings for what your expectations are for capital markets. Specifically, we're going to look at 2 categories of multi-manager strats here: funds of funds, FOFs, and then a multi-strategy fund itself. Basically, one's in-house and one isn't. So we'll do funds of funds firstly. So this is where we have a hedge fund which simply makes investments in lots of different hedge funds. And those hedge funds might be managed by different firms. In fact, they will be. So why are we doing this? Okay, why are we putting 20% with hedge fund A, 20% with hedge fund B, and so on? Well, there's different strategies. So although there's diversification within each hedge fund strategy to a greater or lesser extent, we've already talked about that in this reading, you're naturally now diversifying within your hedge fund investment. So more diversification benefits. You can pick the best managers, the hotshot superstar managers. You can pick the best ones to hopefully generate returns for your investment. You can pick different strategies and different styles to suit your investment needs. Okay, so you've got lots of flexibility and lots of choice. Not always easy though to find out much. We talked about hedge funds having a lack of transparency. So doing due diligence can be a challenge. Okay, finding out who the best performing managers are. Finding out information about what's going on inside each hedge fund is not a given. So a lot of work has to be done on that one. But overall, you provide lots of nice benefits here in terms of risk reduction. You've got a bit of hedging of your bets. You're spreading your investment across different hedge funds. You can pick hedge funds with as little or as low leverage as you like, to meet your desires, as goes for liquidity as well. Okay, so that's all the benefits really. The drawbacks, very high fees. Okay, so not only are you having to pay, so from the end investor's point of view, if you were to invest in a fund of funds, not only are you paying the fees to your fund of fund manager, but the investments that are then made on the individual hedge funds, you're paying fees to those individual managers as well, both asset management and performance fees. So the fees can very quickly mount up. There's lots of different layers of fees. Every different hedge fund manager there is going to be taking some more fees from you. And with a fund of funds, there's going to be no performance fee netting. Okay, so if you were to invest in an in-house multi-strategy fund, as we're going to see shortly, if part of your investments do well, ordinarily there'd be a performance fee to pay on that, but part of the investments do badly, in-house that'll be netted off. You're not going to have to pay performance fees. But if you're investing externally in hedge fund A and that does brilliantly well, you're going to have to pay big performance fees on that. The fact that hedge fund B has done not so well or very badly, you don't get to reduce the performance fees that you've paid to the other fund. So the fees can be a massive problem for investments in funds of funds. Bit like we talked about before, you've got a lack of transparency and principal agent issues. This is a very grand way of saying that the end investor is just that much further away from the person that's making investment decisions. Okay, so you invest in a fund of funds, okay, fine, so you got your end investor, they invest in the fund of funds then invest in another hedge fund, that hedge fund might be invested in another, and so on. So the person that's making those decisions has got very little sight of the end investor. That principal agent fiduciary relationship is just subject to even more stress in that sort of situation. Okay, we talked about the fees. What tends to be the fee category or the fee structure is what we're looking at. Typically 2 and 20 or variations on the theme. So 2% of management fees, that's on AUM, assets under management. So whatever the assets you have invested with the fund, you have to pay an annual fee of 2% of that. That's regardless of performance. And if the fund does well, so creates lots of value for you, then you're going to be paying 20% of the profits. There might be some hurdle fees, there might be some clawbacks, but overall 20% of the gains tends to be a nice ballpark figure for performance incentive fees. With funds of funds, you've got additional 2 and 20 structures all the way up the pyramid. So the fees really do add up. Usually you've got some lock-up periods, so you've invested, you can't get your money out for a certain time, at least 1 year, sometimes even more than that, so liquidity of the individual investment is often very low. We talked about a potential netting risk, okay, exactly as we talked about in the previous slide. So if you're invested in 5 different hedge funds, 4 do really well, you're paying high performance fees, 1 does very badly, well tough, you're not getting the performance fees back from those well-performing funds. But because you can pick lots of different funds with lots of different strategies, you've got diversification benefits with a relatively small capital investment. Okay, and finally, because your fund of fund manager has got contacts, they're in the know, they're experienced, they're skillful, they'll often have access to funds that might not be available to the individual investor. Okay, implementation. Again, nothing too tricky here. We need to pick the strategies that we want and then invest accordingly. Now, before we do invest though, we want to make sure that we like the cut of the manager's jib. So we're going to interview them. This is the fund of fund manager will do this. rather than the end investor. But they'll interview managers, they'll review the performance of the hedge funds, they'll look at who their third-party providers are, who are their auditors, who are their lawyers. Can we get some information from them? You're going to require to monitor your investment regularly. Okay. You might have picked hedge fund A because it's got a global macro strategy that you like. Well, what happens if we have style drift? It's where the strategy actually drifts away from global macro, perhaps onto something else. So you've got to consistently monitor that the hedge fund manager you picked is doing what you picked them for. If not, then you begin to lose the benefits of diversification. They might end up drifting towards hedge fund B in terms of strategy and style. Well, you've already got that in your portfolio. That's why you picked hedge fund B. So, sort it out, manager A. Based on style drift, based on capital market expectations, the fund of fund manager will alter the weightings of the investment, as you might expect. Overall, though, with funds of funds, good diversification benefits, lower volatility than individual hedge fund strategies on their own, and less downside risk as well. Okay, final element then of our multi-manager strategy is the multi-strategy hedge fund. The key difference here between this and a fund of funds is that it's all in-house. Okay, it's run by one organization. So one investment firm will have a hedge fund A, hedge fund B, hedge fund C, but it's in-house. Now, one of the best benefits here, I'll skip to it straight away, that you do get netting of performance fees, usually. Okay, so if hedge fund 1 that your investment firm has invested in has done very well, yes, the performance fees would appear to be due, but if hedge fund 2 does badly, well, the net profit, if the net profit's zero, your performance fee is going to be zero. So you do get netting of performance fees. The other characteristics are very similar to funds of funds. So nice steady returns, lower volatility than other individual hedge fund strategies themselves. Perhaps one of the downsides of a multi-strategy fund is because it's run by one organization. Now that's got benefits in terms of performance fee netting, but there's downsides in the fact that if the business goes belly up entirely, then your entire investment does. If one of your fund of fund investments went belly up, no problem, we've still got the rest there. So you've got less diversified operational risk. You're reliant just on one firm. Not reliant on one strategy, but you're reliant on one firm. Okay, it's a lot easier in-house to reallocate investments between strategies. Might end up having poorer liquidity because of stricter lockup periods and stricter redemption periods. That depends on the actual terms and conditions that are agreed. Okay, well, you probably know what's coming. How to implement it? Well, it's nice and simple. The multi-strategy manager simply invests in different hedge fund strategy techniques. They can very easily make tactical reallocations, switching from strategy 1 to strategy 2. Obviously, they're going to need a good knowledge of how much capital is going to be needed to successfully implement a strategy. We've looked at it over the past 5. Some do require a lot of leverage, some require not so much. How the funds correlate with each other to get the diversification benefits. Lots of expertise, really, we can sum up at that bullet point. The multi-strategy hedge funds tend to require greater leverage than funds of funds as well, so that's something to think about if you're investing in there. In terms of the role in the portfolio, yes, diversification, low volatility returns, bit more of a left tail risk though compared to other hedge fund strategies.